Hello, our discussions on financial statements continues. In this session, we will continue to prepare the financial statements, but in this session, we'll see when the opening balance sheet is given. That means an existing company's transactions will be seen in this session. So when opening balance sheet is given and the transactions are given, we will try to understand the impact of these transactions on the opening balance sheet. So these are the transactions given. We will try to understand the effect of the opening of these transactions on the financial statements and observe the effect on the opening balance sheet. Besides that, we will also understand the effect of these transactions on the book value per share. So the book value per share is one of the important financial indicators which can be calculated from the balance sheet. So once immediately after preparing the financial statement, we will use those transactions to understand the effect on the book value per share. So the transactions and the opening balance sheet information and the transactions are given here. So the opening balance sheet is showing an assets worth of 550,000 supported by or financed by capital, accumulated profits, convertible bonds and creditor, and the assets are in the form of debtors, investment, stock and cash. So we'll take the transactions. The first transaction is sold 80% of the investment. So the sale of investments for 225,000, and we treat that as a cash sale, so therefore it is also a receipt. Whenever there is a sale, there has to be corresponding cost, and the corresponding cost is 80% of the investments. So therefore investment left out at the end of the year will be 20,000. The next transaction is you're collecting 90% of the money due from X. So it is a collection, not an income. So collection from X is 90% of the money due and 90% of 30,000, and the balance is treated as discount because you're closing the account, and that is 0.10. So as a result, at the end of the year, X is not required to pay anything more. Its account is closed. Then sold entire stock for 200,000. The sale of stock of goods 200,000, stock of goods 200,000, and that is for cash. So therefore sale of stock is an income and a receipt. And whenever there is a sale, there has to be cost of goods sold, and you sold the entire stock, so the entire stock becomes an expense, and stock will no more be available in the balance sheet, so stock becomes zero. Mr. Y becomes bankrupt and pays only 75% of the money due, so the collection is collection from Y, collection from Y is 75% of the money due, 75% 0.75. So the balance is called bad debt. Balance is treated as a bad debt, and the balance is 0.25, 0.25, and that is a bad debt. So as a result, Mr. Y is also not required, will not appear on the asset side of the balance sheet at the end of the year. Then all bonds were converted into shares on 31st March at the market price. So let us do a working. So the bonds convertible is 100,000. The convertible to be issued, okay, conversion through shares, uh, through issue of shares, through issue of shares. So the number of shares to be issued is equal to bonds divided by market price per share. The market price per share is given as 50. So therefore number of shares to be issued is equal to number of shares issued is equal to 100,000 divided by 50. So 2,000 shares. Why do you need this number? This number is required to show the capital and the balance as a share premium. The capital is always shown as the face value 10. So the capital is equal to 20,000 and the premium is 40. So therefore premium is 2,000 into 2,000, that is 80,000. So we are converting the bonds of 100,000 by issuing shares of 10 at a premium of 40, So capital will increase by 20,000. Share premium will appear on the balance sheet for the first time. Share premium will appear on the balance sheet for the first time, and the bonds will reduce. The bonds will reduce by 20 and 80. Okay, so the bonds will reduce by, so the share premium and the capital and the corresponding reduction in the convertible bonds completes the transaction. The capital increases by 20,000, share premium increases by 80,000, and the bonds are reduced by 20 and 80, that is 100,000. So that is the conversion of the bonds done. Salaries per month is 5,000 and salaries are paid at the beginning of the subsequent month. The salary for the period is 5,000 into 12. So 5,000 into 12. Okay. But you make the payment, salary is paid only 55,000. So there is an outstanding salary or salary accrued. Outstanding salary is 60,000 minus 55,000 is the outstanding salary. Dividend received is an inflow of cash and also income. So dividend received is an income, and dividend received is cash inflow, is 20,000. Cash inflow is 20,000, and dividend is an income. Declare stock dividend. We'll pick that item after completing the financial statements, because, or after preparing, or after determining the profit after tax, and then understand the effect of that on the book value per share. Assuming that no other transaction there, we have to make the transaction, record the transaction relating to the interest. You can see that the bonds were converted at the end of the year, so we have to pay the interest, and interest is an expense, and interest is an outflow of cash. Interest is expense and interest is outflow of cash. So the total inflow or income is 445,000. Total expenses is 251,500. So profit before tax is equal to 445 minus 251, so 193,000. Assuming the tax to be, we are given here tax is 20%, so tax is 0.20, so 38,700, and let us assume that we paid that tax 38,000, so PAT is 193 minus this, so 154,800 is a profit after tax. For the time being, ignoring the dividend, let us assume that we paid the interest, we retained the entire profit, so therefore profit, accumulated profit goes up. Accumulated profit goes up. So accumulated profit increases, assuming that the entire profit has been retained. So the cash in hand is the total cash inflow, and which is opening cash. Opening cash we had 310,000, so the total cash in hand is 789,500. The cash outflow is 99,000, so cash in hand is 689,800. So cash in hand is 689,000. No other transactions, so no change in the creditors during the period, and the totals of the assets should be equal to the total of the sources. Now let us, in this case, we have retained the profit, entire profit retained. If the entire profit is retained, we have seen that the entire PAT is added back to the accumulated profit. So let us find the equity at the end of the year. Equity at the end of the year is assets minus the liabilities. The liabilities are outstanding salary, outstanding creditors, and outstanding bonds. So the equity is equal to A minus L. The number of shares on this date is 120,000 divided by 10. So therefore book value per share is 55. The book value per share is 54.6. Book value per share is 54.6. What is book value? The book value per share is equity by number of shares, or it is assets minus liabilities by number of shares, which is also called the asset backup per share. So the book value per share without the distribution of dividend is 54.6. Now let us, so this is what we assumed here. The entire profit has been retained. Now let us change that decision and say that this entire profit, okay, the entire profit is okay, entire profit, okay, is not retained, but there is a dividend distributed. Let us assume that dividend distributed is equal to 60,000. When I distribute the dividend, dividend is not a cash flow, is not an expense, but a cash flow. So therefore, in the cash flow statement, the dividend will be shown as a cash outflow 60,000. So will increase cash outflow will increase by 60,000. Cash outflow will increase by 60,000. Then we have no change in the PAT. PAT will not change. The cash is changing. Cash is now 629,000. But we can see that the accumulated profit will be 154 minus 60,000, that is 394,000. Balance sheet tallies, but what is the difference between the previous transaction and the current decision, or the previous book value and the current book value? The difference is the size of the asset come down. So minus 2,000 minus 50,000 minus 0. So the number of shares is 12,000. So the book value per share is 49.6. Previous case was 54. Now it is 49. So when we distribute the cash dividend, the dividend is a cash outflow, no effect on a profit after tax, but the retained profit or accumulated profit changes, because the accumulated profit is opening accumulated profit plus the current profit minus the dividend distributed. So as a result, the book value per share falls. Now if you take this and once again we change our decision, we say that the dividend distributed, but instead of cash dividend we give stock dividend. Now when we give stock dividend, the number of shares, and stock dividend is in the ratio of 1 is to 2. 1 is to 2, that means 1 share for every 2 shares you're holding. So therefore, we are at present, there are 12,000 shares, okay? Present 12,000 shares, 12,000 shares. So the stock dividend is given 1 is to 2, 1 is to 2, so 6,000 shares are given. So the face value of the shares, face value of the share is 10. So the capital will increase by 60,000, and retained profit will reduce by, so capital will increase by 60,000, whereas the retained profit retained profit will reduce by 60,000 once again, will reduce by 60,000. No change in the cash because we have not paid cash dividend, or we have not paid the dividend in the form of cash, but the retained profit has reduced. The retained profit has reduced because of the distribution of dividend in the form of the shares. Here also we can see the number of shares has increased from 12 to 18,000, the equity remaining constant. Because the number of shares go up, the book value per share falls to 36,000. So when we take a decision, the decision will affect the balance sheet, income statement and cash flow. To reiterate, every decision that the business takes can be examined and can be seen through the financial statement, balance sheet, income statement and cash flow. So every decision will find a place in the financial statement in the form of financial items, but by observing the financial statement, it is possible to understand what are those decisions, and is necessary to examine the effect of those decisions on some important indicators, and one such indicator is the book value per share. So as we move along, we'll pick up few more decisions and understand the effect on the financial statement. We keep on consolidating this process of converting the business decisions into financial statement and start examining the effect of the decisions on some important indicators like the book value, like equity, like earning per share, and so on and so forth. Thank you.